The Alpha Horizon. Thinking different. Acting aware.
Hello and welcome to the Alpha Horizon podcast from Algebris Investments. Deciding on asset allocation, portfolio positioning and where to invest so far in 2022 has been challenging enough, given the regime change in terms of the inflation and interest rate environment. At the risk of understating things, developments on the geopolitical front have clearly created increased uncertainty and volatility. I am joined by our investment strategist Simon Peters for this shorter episode to discuss how the environment for risk assets has changed and to consider what investors and asset allocators are doing, and also what can they do in terms of positioning. My name is Douglas Branson and I'm Head of Business Development. Hi Simon, thanks for joining me.
Hi Doug.
So given the title of this episode, This Wasn't Supposed to Happen, let's start with what wasn't supposed to happen and why wasn't it meant to happen.
Coming into 2022, we waved the flag of inflation. The US printed a 7% inflation number early in January, while Germany and even the rest of Europe hardly lagged, posting 5.7%. These high inflation numbers finally got the attention of central bankers. The Fed and Bank of England became hawkish, and even the ECB woke up. Nothing less than monetary regime change has just occurred. This is a momentous change in market dynamics and will be with us for years, not months. Yields and interest rates have surged. Investors and markets were not prepared for this sudden change. A lot of investors had large quantities of long-duration, high-quality bonds, as well as growth equity companies. Year-to-date, bond markets have performed poorly, as have equity markets. This wasn't supposed to happen. Investors had assumed inflation would be temporary and monetary conditions would remain very accommodative, yet the S&P is down 9% year-to-date. We believe asset bubbles will likely to continue to deflate. Long-duration, high-quality assets that were bid up by central bank QE programs are going in reverse. High-multiple growth equities are likely to also see the air come out of their valuations. Russia invaded Ukraine has pushed this current risk-off trend further. Interestingly, despite the volatility in the equity markets and general investor worries, the bond market has remained very orderly, with the US 10-year only just coming off its highs, suggesting the bond market so far does not see long-term consequences of a change in monetary direction.
Understood. Thanks, Simon. And look, talking to investors over the last few months, we know that some have started to adjust portfolios by reducing duration. But more generally, what is your impression of what investors are doing at the moment?
It is clear that those clients who were able to be nimble began to reduce duration and top-slice some sovereign debt. However, with bond markets close to their peaks and the S&P close to all-time highs at the beginning of the year, there seem no obvious areas to rotate existing holdings and asset allocations into. As such, a lot of investors broadly kept allocations that they had in the second half of last year. They have seen both their bond and equity positions leak performance year to date, which has begun to lead to a risk reduction trade of a continuous trim of bond holdings and a reduction in some equity holdings. Investors have a problem. Inflation is high, and there's little ability in the current bond or equity markets of beating real inflation through yield and or capital appreciation, which is beginning to hit investors' objectives.
And following on from that, how can investors and asset allocators position portfolios in the current risk-off environment?
Inflation isn't letting up. Italy just announced its February inflation print up 6.2%, well ahead of consensus expectations. The Russian invasion of Ukraine adds an additional inflationary impulse to an already high inflationary environment. So despite the risk-off initial reactions in the market, I doubt the Fed in the US is going to pull back from interest rate increases, and it's not obvious that the ECB will be able to become more dovish either. Germany is busy committing to additional defence expenditure, and Europe overall will spend whatever it takes on reducing its dependence on Russian gas, so a fiscal impulse. What this means is that the monetary regime change that we have been discussing is unlikely to go into reverse just because of the risk-off market reaction to the war. As such, investors need to think what areas of the market can perform during a period of inflation. In bond markets, you want a combination of high yield, but with relatively low duration to protect yourself from interest rate volatility. We see that combination in one area that we look at, and that is subordinated financial bonds. Additional Tier 1s currently yield around 5%, with durations less than half the average duration of general bond portfolios. In the equity markets, European banks need to double just to bring their current dividend yield of more than 7% down to their 25-year average of 3.5%. And it's interesting to note that almost any alternative investment, bonds, equity, property, yield well below their average yield over 25 years, not 2 times. Of course, banks are one of the biggest beneficiaries of interest rate and yields going up. So there are pockets of yield and potential capital appreciation that can help investors build a portfolio to beat inflation and provide real positive rates of return.
Great, thank you. So to finish, there's been a fair amount of discussion about the growth versus value relationship. Taking technology as a proxy for growth and financials as a proxy for value, can you please talk through your thoughts on where the current opportunity is in equity markets?
Higher interest rates are not necessarily bad for equity markets, but there are a few points to note. Higher interest rates tend to depress both earnings and valuation multiples, so equity markets could struggle over the next few years. Now, peaking stock markets, inflation, a tightening cycle, and macro headwinds have parallels with 2000-2001. At that time, we saw the Nasdaq fall close to 60% over 14 months, but US and European bank equity rallied 19 to 37% over that same time period. Now, I don't have a strong view on the Nasdaq. However, it does look as though the banks are likely to see earnings upgrades from higher rates over the next number of years. Our estimates are between 10% and 40% upgrade in their earnings, which means dividends are likely to grow from where they are right now over the next 3 years. It looks like banks are likely to see solid earnings momentum over the coming years. Bank equity or bank subordinated debt, combination of both, seem a pretty good hedge for the current market backdrop. We would update that by saying we would avoid banks that are heavily involved or have large exposures in Russia or Ukraine right now.
So that leaves me to thank Simon for his input, and as always, to thank our listeners for tuning in.
Thank you. Goodbye.
Until next time.
The Alpha Horizon. Thinking different. Acting aware.